Hey guys, it's Christian, your local realtor. And for this video, I wanted to talk to you about the trigger rates you've been hearing all about, and you may not even know what this is, or how it affects you, or what do you do if you hit your trigger point. So I wanted to share what I've learned this week. I've studied it like a student, and I've gotten some pro tips from mortgage brokers as well about how you can stick handle through this trigger rate point. So that's what we're gonna discuss right now. Okay, so the first thing you have to know is you can't predict mortgage rates. Warren Buffett has this famous line where he said, if I knew what interest rates would do tomorrow, I'd be rich. So he's telling you he doesn't know, and by extension, you don't know, I don't know, nobody has an idea. However, the best advice I've gotten in the multiple half a dozen brokers I've spoken to is to grab a fixed term interest rate for the next 2 years, wait until this environment settles, and catch the variable on the way down. That sounds like really good advice because we presume 2 years from now inflation will be under control and thereby interest rates will have steadied. So I think that's the best advice I've heard so far. If I were getting a mortgage today, I would grab the fixed myself and then roll into a variable 2 years from now. Now, that said, you have to know that there's 3 types of mortgages. There's the fixed mortgage, and is self-explanatory, a variable mortgage, which comes with a fixed payment, or called a static payment. And what that means is, as the rate rises, the amount of interest you pay rises, and the amount of principal you pay off your mortgage declines. And the trigger point is when you are paying 100% interest and nothing off your principal. So that's when the bank notifies you, usually by a letter in the mail, and says, okay, you've got a few options here. What do you want to do? And so the options would be, one is you make a lump sum payment, which would be, you could pay $50,000 off. So let's say you owed $800,000 on a home you bought for $1 million. So that's an 80% loan to value. Well, you got to be under 80%. That's what it, that's the way it works. And so maybe you pay down $50,000 if you have that in savings. If you don't, well, the next option is just to increase your monthly payments. Or a third option would be to roll into a fixed term mortgage, which will also increase your monthly payments, but at least you're not biting your fingernails. You're not, awake at night worrying about where the mortgage rates will go. And the third type of mortgage is the adjustable rate mortgage. And this is commonly offered through Scotiabank. The benefit for this type of mortgage is that the amount of principal you're paying down is the same. However, as the rate goes up, so does the interest, which means your payment goes up. Now, I have this mortgage, and I've got to tell you, if I were to do it over again, I don't think I would go with this mortgage. However, Scotiabank tends to be more aggressive and providing loans. So this one allowed us to buy a lot more house. And so that's why we chose it. That being said, it does have me biting my fingernails. And so, if you have to make sure that your cash flow situation is predictable or is stable. Obviously, as a realtor, I work as a self-employed person in sales, so sales are unpredictable. We've got really, really good months, and of course there's months where we have no sales, which is very normal for 98% of realtors in the business. And normally you will have one of 2 problems with the increase in rates. One is it's a cash flow situation for you, or the other one is your amortization period under the variable has gotten so long. My wife was telling me about a friend of hers who now has an amortization period of 60 years because she's almost paying all interest on her mortgage. So she's hoping to have her mortgage paid off by the age of 97. Well, she's close to her trigger point, of course. Now, cash flow is going to be the issue, I think, for most of you. If it's an amortization issue, you probably could just kind of wait it out, until the rates level off or start to come back down. If it's a cash flow issue, here's what you could do. There's sort of about 4 or 5 things, really. We've already talked about 2 of them. One would be to increase your payments. The other one would be to do a lump sum payment. So make sure you're at 80% loan to value or more. A third option, of course, would be to convert into a fixed rate mortgage, which will come with higher payments, but at least you will sleep easy. A fourth option would be to move from bi-weekly payments to monthly payments. So this will save you 2 payments a year. So if your mortgage is $3,500 each go round, that would save you $7,000 and put that in your pocket. A fifth option would be, and if you could refinance depending on how much your amortization period is, from a 25-year amortization to a 30-year amortization. So that should lower your payments, give you a bit of breathing room. Now, of course, that would likely cause you to have a penalty because you're breaking your mortgage. And the way I understand it is you can take that penalty amount and then roll it into your new mortgage and pay it off that way if you don't have the money lying around to pay that. So those are, those are some ways you can stick handle through this rising rate environment that could trigger your trigger rate. And if you're wondering, where do I find my trigger rate? It would be in the mortgage documents that you signed at your lawyer's office 2 or 3 days prior to closing on your purchase. If you don't have those documents lying around, probably the best way would be to go to your local bank, talk to a really good financial advisor, and they can sit down with you and they can basically calculate it for you. Okay? So watching this video, you may still be asking or wondering, well, what's the benefit of a variable or an adjustable rate in this environment? And the benefit as of making this video is that the rates for those 2 types of mortgages are still lower than a fixed rate mortgage, which means that you could qualify to buy more house, buy more condo, because the rate is less than a fixed mortgage rate. Okay, so those are just some ideas for you. If you were putting this into specific numbers, know that the 75 basis point increase translates into basically $450 more on every $100,000 you owe. So if you owed $1 million, you're paying an extra $450 a month now on your mortgage. So hope this has been of value to you. If it has, give us a thumbs up. We appreciate it. And subscribe. We do love having you. Leave your comments or questions below. At the very least, maybe leave some comments about how this is affecting you, or if you have some pro advice for us in terms of how to handle the rising rate environment. Thank you.